Hi, good evening, everyone. Thank you for joining us tonight for the presentation. These are the dates for the upcoming FOFs, so you can note these. So this is the sixth talk in our wealth management series that we've been running. In case you've missed any of the previous 5 talks, the recordings are available on our YouTube channel, so you can go through those. Today, I'll be presenting on how to choose a fund manager. Now, last month, Raj made a presentation on personal taxation, and when that recording was uploaded on YouTube, somebody made this funny comment that there is so much of hassle in taxation that it's better not to earn any income. So, in case of investments, if you don't want to go through the hassle of choosing a fund manager, there is a better alternative than not earning any or not doing any investment. You can still invest in passives. So I thought a good way to start would be to answer the question, is it even worth the time and effort to try and pick an active fund manager? Now there are various arguments both for and against passives. The argument in favor of passives, or the most common argument in favor of passives, was made by William Sharpe way back in 1991. And he said that if you look at investors and if you divide investors between passives and actives, then the passive investors as a whole own what is called the market portfolio. So they own all the stocks in the weighted based on their market caps. When you look at active investors, they will also own the exact same market portfolio as an aggregate. And the reason is, if one particular active fund manager is overweight some stock, then by definition, some other fund manager will have to be underweight that exact same stock. So active investors as an aggregate will also own the same market portfolio that passive investors are owning. However, the active investors will pay a higher management fee, and consequently, he argued that active investors are bound to, as a group or as an aggregate, are bound to underperform the passive investors. The other argument in favor of passives was made by Michael Mauboussin, and in his paper on the paradox of skill in investing, he argued that as more and more active investors get skilled, the difference between the best performing active fund manager and an average active fund manager will come down over a period of time. And he showed the returns for US large cap stocks, and he showed how the alpha for US large cap funds over time has consistently come off. Now, there are some simplifications in all these arguments, and a good paper to read on these simplifications or why there are reasons active can outperform is this paper by Lasse Pedersen from AQR, and it's called Sharpening the Arithmetic of Active Fund Management. And I'll just cover some of his points as well as some of our own points in which suggest why active can outperform. So one of the simplifications that academic theory makes is that they say that the passive investors own the market portfolio, and market portfolio is essentially a portfolio of all stocks listed anywhere in the world, weighted based on their market cap. Now, as you can imagine, in practice, a passive investor is not owning the market portfolio. He or she is actually owning an index fund. Now, an index will typically own a certain segment of the market and leave out the other segments of the market. So let's say somebody invested in a Nifty 50 index fund, and 5 years down the line, they realize that there was a bull market in small and mid caps, and they've missed that rally in small and mid caps. Or somebody might invest in a Nifty 500, and Indian stocks don't go through a great time over a 5-7 year period, while US stocks do well or other geographies do well. And in that case, that passive investor loses that outperformance in that segment of the market. So the point is, an investor, it is not a no decision portfolio. The investor has to make a very critical decision as to which index to invest in. The second issue with passives is, again, in academic theory, it is presented as a buy and hold portfolio forever. So once you've owned the market portfolio, you don't need to do anything. As the market cap of the stocks changes, your portfolio will keep rebalancing over time without doing any trades. In reality, this does not happen. The universe of stocks keeps on changing and the indexes keep having inclusions and exclusions. This creates two problems. One, the passive index fund also has to trade and incur some trading costs. The second issue is, anytime there is a corporate event, like let's say a demerger, it provides an opportunity for the active fund to exploit the inefficiencies of the passive. For example, let's say a Nifty 50 firm, a large cap firm, is demerging a small business segment. When that segment demerges, it is likely that that demerged business is a small cap or a mid cap, and by the rules of index construction, it will be kicked out from the index, irrespective of the merits of that business. Active fund managers or active investors will not have that kind of a restriction. So these kind of events provide an opportunity for active to outperform the market. The third issue is that while broad market indices, at least in India, are fairly diversified in terms of their sector exposures, at market extremes, indexes can become very heavily concentrated in select sectors or select segments of the market. So, for example, in the dot-com bubble, at peak, the index had something like a 25-30% exposure to the tech sector. In 2007, the index as an aggregate had something like a 50% exposure to cyclicals like oil and gas, telecom, and capital goods, while only 6% of the exposure was to FMCG and pharma companies. So at extremes, the indexes are not giving you the kind of sector diversification that you typically want. The other problem that has emerged for passives in the last few years, as passive funds have grown in size, is that because some of these passive funds have become so big, on the rebalancing date, the trades of these passive funds can be materially larger than the actual volume of the underlying stocks. And consequently, there is an army of analysts and arbitrageurs that has come up who try to exploit this knowledge of index inclusion and exclusions. So this is the data from Dimensional Fund Advisors, and this is for S&P 500 index. And what they showed was that 5 or 6 days before some stock is added to the index, the arbitrageurs start positioning themselves. The price of that stock keeps going up. On the day of rebalancing, they sell the stock at a higher price to the index fund, and post which the price actually comes off. So this knowledge of their trades to the active investor is again providing an opportunity for the active managers. Again, in many cases, if you are a fundamental investor, you will feel that it's come to a stage wherein the tail has started wagging the dog. So there is more talk of whether a particular stock is getting included in an index or getting excluded than the underlying fundamentals of that firm. So these are some limitations with passive funds. Now, active investors can also outperform by exploiting the inefficiencies or constraints of other active investors. So again, in theory, all active investors are considered as one single group. But in practice, there are various different kinds of active investors. So there are FIIs, there are retail participants, there are mutual funds, PMSs, and each of these has their own set of constraints. So for example, FIIs will have, various stocks will have FII ownership limits. If the stock has hit that limit, the FII cannot own that stock irrespective of whether they like it or not. Similarly, they might have gaps or they might not have the kind of on-ground presence that domestic investors have. When it comes to retail, it is seen that there is a preference or there is a fancy for IPOs, and many times they might be willing to subscribe to overpriced IPOs. You can see a fancy or a preference for bonus stocks. So these days, if there is a bonus announcement, you see the stock price going up by many percentage points without any commensurate change in fundamentals. Again, for retail, it is seen that there is a preference for high beta stocks. The point is, when retail is taking an overexposure to these stocks, other investors can be underweight these stocks and outperform the aggregate market. When it comes to MFs, they also have their own set of constraints. So there will be typically risk limits or internal limits on stock and sector exposures. So typically MFs will not be able to own more than 10% in a given stock. They will want to constrain their sector exposures below a certain amount. If it is a thematic fund, then you will have way more constraints, and we'll have more to say on that going forward. But the point is, MFs have their own constraints which other investors might be able to exploit. So we've seen arguments both in favor of passives and in favor of actives. What does data say? Now, one data that is frequently mentioned or frequently talked about is the SPIVA reports. So SPIVA is S&P indices versus active, and this is published by S&P Global. And basically what the report says is that a large majority of active fund managers underperform their benchmarks. So as per their data, if you see, 85% of large cap funds underperform the benchmark. 70% of ELSS funds over a 5-year period have underperformed the benchmark. And across categories, you see somewhat similar number of funds underperforming their respective benchmarks. Now, this report is talked about a lot, but there are some severe issues with the way this data is analyzed. One of the issues is that in their analysis, S&P Global is using regular schemes of funds. Now, as you know, regular schemes have a higher expense ratio than the direct schemes. So that is one point against active that they're using. The other issue is that they're comparing essentially apples to oranges. They're comparing an active fund versus an index. Now, a passive investor is not investing in an index, but you are investing in an index fund. And as we saw earlier, an index fund has to incur transaction costs, and they also have to pay some expense ratio, even though it might be very less versus active, but there are these costs that are associated with index funds. So it's not an apples to apples comparison. So I took this data as of May 2024, and this is large cap funds, and I compared them with Nifty 50 index fund. The reason Nifty 50 and not Nifty 100 is because that is the only index fund that had a 5-year history. And if you do this comparison, almost 65 to 70% of the active funds managed to beat the index fund returns. When you look at flexi-cap funds, again, the index did not have a 5-year history, but only about a 4.5-year history. So I had to restrict my timeline to that. But over a 4.5-year period, roughly 45% of the active flexi-cap funds managed to beat their benchmark. So the conclusion I draw from this is that the base rates for active investing are not great, but they are also not as bad as what some of the media suggests. If you see the outperformance by some of the active funds, there is a sizable outperformance. So provided you can put in the time and effort to find an active manager, it might be worth doing it. Now, when trying to find an active fund or an active fund manager, the first thing or the only thing that most people rely on is past returns. Now, there is a lot of research that has been published on this in US, in other geographies, in India, and almost all of them have somewhat of a similar conclusion. And that conclusion is that return persistence of funds is weak it is not very strong. You cannot simply rely on returns. The only segment wherein the return persistence is strong is the worst performing funds. So if, let's say, in the bottom quintile or the bottom 20 percentile of funds, those are the funds that have underperformed over a long period of time. That is the segment that you can expect that will continue to underperform. But outside of those worst performing funds, the return persistence is not very great. You cannot simply choose the top performing fund and expect that it will continue to remain so. So I looked at this on a number of time frames. So this is 1 year return of flexi-cap funds. The x-axis is the return in a particular year, and the y-axis, this is the return rank or return percentile. So the lower the return percentile, that better a fund has done versus the other funds. And the higher the return percentile, the worse it has done. And the x-axis has the rank in year X, and the y-axis has that rank in the subsequent year. And as you can see, it's completely random. So a fund that does good 1 year can do bad the next year. On the other hand, a worse performing fund in 1 year can actually do very well the next year. So there is actually hardly any return persistence when you look at 1 year returns. It's completely noise. This is the same data using 3 year returns. And again, what you see is that it's also largely noise. Even on 3 year return basis, you cannot make any conclusive judgment as to whether a fund will continue to do well or not. Now, this is surprising because the data is very conclusive that this is noise, and a lot of reports suggest that this is noise. However, a lot of rankings and rating methodologies continue to incorporate 1 year, 3 year returns in their models. Coming to 5 year returns, I broke the sample down into 2 separate categories. One is funds wherein you saw major fund management or fund manager changes over a period of time. And this is those kind of funds. So these are funds wherein in a totality of 10 years, you had multiple fund manager changes. And in these kind of funds, as you would expect, the return persistence is hardly anything. So because there are frequent fund manager changes, again, you cannot make any conclusive statement about the performance of such a fund going forward. These are funds wherein the fund management team was largely stable over that 10-year period. And this is the only sample wherein you see some return persistence. So the return persistence is not very strong, but it is still there. So essentially what we are concluding from this is that if you are going to look at past returns, look at long-term returns. Any return less than 5 years is practically noise. Again, those returns will be or that data is useful only so long as the fund management team is stable for that fund. To the extent that the fund management team changes, that data is no longer relevant. Now, one reason why short-term returns are not that important or that they keep mean reverting is because investment styles and sectors keep going in and out of favor every 3 to 5 years. So in the short term, the return that you are noticing for a fund is essentially purely because that particular style or sector did very well in that short term period. So for example, if you were, this is a New York Times article from just after the dot-com bubble, and what they're saying is that if you looked at the top performing funds at the peak of that dot-com bubble, almost all of them had very high exposure to tech stocks, growth stocks. These were fund managers that were heavily reliant on growth at the expense of valuations. But when that tide turned, when that cycle changed, all of these funds went from the top performing, being the top performing fund to the worst performing funds. So in the short term, what you're typically seeing in returns is just what style or sector did well. So past returns alone cannot justify or cannot substitute due diligence. So if you're doing due diligence, where do we start? In my view, the most important question while doing due diligence is, do you understand how a fund manager generates alpha? I think this is one aspect wherein most investors have a very low threshold or very low bar for fund managers. Every fund manager will have a stated investment strategy or investment philosophy. But as an investor, don't take that stated strategy or the stated philosophy at face value. Critically analyze and question that strategy. Does it make sense? Should this strategy outperform in a long run? Does the portfolio actually reflect the strategy that the fund manager is talking about? You can look at historic portfolios of the fund and try and see whether that strategy has been consistently applied or not. Now, many of you might be aware of Bernie Madoff and the fraud that he perpetrated. So he ran one of large US hedge funds, which was found to be a fraud. And the person who found the fraud was Harry Markopolos. And he wrote this wonderful book called No One Would Listen. And it's interesting because Harry Markopolos did not set out to uncover fraud. So he did not know that this fund is a fraud, or he did not think that it is a fraud. He was himself a fund manager, and his partners came to him and told him that there is this person, Bernie Madoff, is running this fund which has great returns. Can you try and understand his strategy and reverse engineer the strategy so we can launch a competing fund similar to his? So he went down and tried to understand the strategy. And as soon as he did that, he realized that things didn't add up. So this is what he writes. He says, literally it took 5 minutes after reading his strategy paragraph to determine that he wasn't really using the described strategy to earn the returns he said he was. Now, as investors, we are not trying to uncover fraud, and with SEBI's checks and balances, it's extremely unlikely that there is a fraud. But this is the mental model that you should adopt while looking at or while evaluating a fund manager, trying to scrutinize the strategy with the underlying holdings. So some of the things that we can look at to understand the fund manager's strategy is, what is the stated philosophy, and consequently, what is the investment universe of that fund manager? So is it a fund manager who focuses on long-term compounders kind of stocks? Does the fund manager focus on cyclicals? Does the fund manager focus on special situations? Do they focus on small and mid caps? So what is the universe that the fund manager is typically operating in? What is their portfolio allocation strategy? Do they run a diversified fund? Do they run a concentrated fund? Typically, what is the kind of weights that the top 5, 10 or 15 stocks have? What is the view on sector allocations? Do they run a portfolio which is diversified across sectors, or do they prefer certain sectors? What is the portfolio turnover? Do they take cash calls or not? And most importantly, is that strategy and style consistent over time? If a fund manager's strategy and style keeps changing, then you have no way to conclusively determine how they will perform going forward. Finally, one really good question that I've come across in many due diligence questionnaires is, can you answer under what conditions that fund manager will underperform or outperform? If you understand the style of the fund manager well, you will be able to answer this question to a good degree of certainty. So some of the things that you can look at while understanding the strategy are the active share of the fund. Now these are the active share of large cap funds, and there is no right or wrong number here, but if the active share is extremely less, let's say it's something like 25-30%, active share is how much of the fund is different from the benchmark. If the fund is, let's say, has an active share of 25%, then 75% of the fund is the same as what the benchmark is. So with a 25% difference, can the fund manager really outperform the benchmark? Again, you are not looking at this as just at a point in time, you are looking at it over a period of time. So this is just a sample fund wherein if you see the active share has remained more or less between 60 to 70%. So the strategy of the fund on this count has been more or less stable. But if the active share is continuously very low over a long period of time, then probably you need to question whether it's just a closet indexed fund. The other thing is portfolio turnover. So does the fund manager have a buy and hold kind of an approach, or does the fund manager makes transactions frequently? Now again, at a point in time, this might not be very useful. So these are two flexi cap funds, and if you look at the portfolio turnovers today, they're both about 25%. But if you look at the longer history of both funds, in one case, the portfolio turnover has been continuously coming down with the same fund manager, while in the other case, the portfolio turnover has been largely stable over a period of time. Again, this would lead to questions, or this can lead you to ask questions around, has the fund manager strategy changed, has the environment changed, or what has led to the portfolio turnover coming down over a period of time. So we saw that return persistence of funds is not very great. So return in 1 year or even on a 3-year basis is not very highly correlated to subsequent returns. But what you generally see is that risk metrics have a good degree of persistence. So the risk profile of funds remains to a great extent stable over a period of time. Now there are various risk parameters you can look at. In this case, the risk metric I looked at was upside versus downside alpha, or in this case, upside alpha minus downside alpha. So what this essentially tells you is, does the fund manager generate most of the alpha during bull markets? Is it an aggressive fund? Or does the fund manager generate most of the alpha during bear markets? And consequently, is it a defensive fund? And what is plotted is that number for flexi cap funds over a different 5-year period. So y-axis is 2019 and x-axis is 2024. Essentially, what this chart is saying is the funds which were aggressive in 2019 are even aggressive today. They are still generating most of the alpha during bull markets while giving up some of the gains during down markets. On the other hand, the defensive funds which do well during bear markets have continued to remain defensive. So some of these metrics can help you understand or answer that question, under what circumstance the fund will do better. So again, that was one metric, but there are various different risk metrics you can look at. You can look at drawdowns historically, the volatility of the fund, beta, Jensen's alpha, information ratio. So broadly, any risk ratio typically you will see remains more persistent than return-based numbers. Now, as we saw, if there is a continuous turnover in the fund management team, then your return numbers or even the history of the fund becomes meaningless for you. So the problem is that without a long-term history, or if the fund management team has continuously turned over, you really don't have enough data to judge the skill of that fund manager. If you've not seen the performance of that fund over multiple cycles, or that fund manager over multiple cycles, you cannot judge the performance of that fund manager. Unfortunately, in the industry, this data is hard to come by, as in there are very few fund managers wherein you have long-term track records. So if you look at, I looked at 3 categories. This is flexi cap, large cap and small cap funds. About 65% of the fund managers were with a given fund for less than 3 years. Only about 24% of the fund managers stayed with the same fund for more than 5 years. And only 6% stayed with the same fund for more than 10 years. So while having a long-term history is important, the challenging part is there are very few fund managers that would pass that hurdle. The things that you can understand or you can look at on this aspect are, what is the fund manager churn at fund house level? And typically you will find that in some fund houses, the fund management team has a constant churn. So every couple of years you see fund manager changes. While in some fund houses, the team is relatively stable. Second, is there an alignment of interest. Does the fund manager own a sizable equity in that organization or in that fund house? Again, in case of mutual funds, there are very few wherein this is true, but you will find that many PMSs or AIFs wherein the fund manager owns a sizable stake in that organization itself, and there you can have more certainty that that fund manager will stay with it for a long period of time. And generally, you're trying to understand based on their interviews, based on their interactions, what has made them stick around for a long period of time. So, the fund manager's skill is important, but it is equally important to understand the environment or the organization wherein that fund manager is operating in. Now, in my view, this is one of the major changes that has happened in the industry in the past 15 years. So, 15 years back, you could probably associate a distinct investment philosophy with each of the major fund houses. Today, there are very few fund houses wherein there is a uniform philosophy across all the funds or across all their fund managers. What has happened is that fund houses have also realized that styles and sectors can go in and out of favor. And in order to maintain some sort of business continuity, they've adopted broadly two different approaches. One approach that some fund houses have taken is that they've said, we'll employ multiple fund managers with different styles. So if one fund manager and one style is out of favor, there will be other whose fund or that style is doing fine. The other set of fund houses have taken the approach wherein they have reduced the discretion that is available to any fund manager to deviate from the benchmark. And this looks something like, let's say if the index or the benchmark has 60% allocation, 20% allocation to growth stocks, then they will have limits like the fund manager cannot be less than 15% or more than 25% in growth stocks. So essentially what they're saying is, the fund manager cannot deviate very widely from the benchmark on either style or sector. Now, I'm not saying one of these is better than the other, but this does have a huge implication on how much discretion a fund manager has to implement their own ideas or their thoughts. And again, if you look at the interviews of CEOs or CIOs of different fund houses, you can very well guess which of the three categories they are falling into. The other reason it is important to understand the philosophy of the fund house is that even when there are multiple different fund managers in an organization, they will share the exact same research team. So the same person covering auto is covering auto for all the fund managers. So their source of ideas is still the same. Second, in most organizations, there will be an investment committee which will review the portfolios every month or every quarter. And this will be the same investment committee. So again, they will try to bring in some sort of uniformity in the different portfolios. So if you look at the data, so I looked at 4 different categories. I looked at flexi cap funds, focused funds, ELSS funds, value funds. And I looked at how much was the overlap between these funds within the same fund house and within different fund houses. And what you find is that within the same fund house, the portfolios are all, on average about 51% similar. On the other hand, when you compare across different fund houses, they are only 26% similar. So this suggests that the organizational environment does have a huge bearing on how the portfolios are getting constructed. And so it's important to understand the organizational environment. Now, some of the things that you can look at while doing organizational due diligence are, what is the management and the promoter pedigree? What is their profile? What is their history? How long have they been in this firm, in this business? Is the firm well capitalized? Again, for mutual funds, SEBI has quite stringent capitalization requirements, but in case of smaller PMSs or other entities, you might need to check these. What is the turnover of the investment team? We spoke on this. what is the strength of the research team, what is the turnover in the research team, how good is the compliance and the risk management team, what is the kind of experience that they have, how good is the customer service network, who's the custodian, who's the auditor. Again, taken together, this can give you a good sense of how well run or how professional that organization is and what kind of environment the fund manager is operating in. Now, once you've selected a fund manager or you've identified a fund manager and a fund house, oftentimes you might have different mandates that are run by the same fund manager, or you might have the choice to allocate between different mandates. And what we are arguing is that ideally flexible mandates are preferred over constrained mandates. And there are a couple of reasons for this. If you look at the history of any geographic or any market, you will find that themes or sectors keep going in and out of favor every couple of years. So like 10 years back, FMCG and pharma were the best performing sectors. Today, they are probably in the lower half. Cyclicals like realty, infra, industrials were performing poorly 5-7 years back, but today they are doing very well. So themes and sectors keep rotating. Now the problem with this is that the difficult questions that typically a fund manager needs to answer now need to be answered by the investor. The investor needs to time the theme. Now fund houses will often tell you when to invest in the theme, but they might not tell you when to exit out of the theme. So timing the theme is investors' responsibility. They need to get in and out on the right time. How much to allocate to that theme? Again, if it's a thematic fund, typically it means a concentrated exposure to a certain set of sectors. So you don't want to allocate a very high amount, but still, what is that amount? In a flexible mandate, it is the fund manager who will take these decisions for the investor. But in thematic funds, it is the investor who will have to do this. Now, assuming that even if the investor is able to time these well, this is still tax efficient, because anytime you will sell a fund, you will incur capital gains tax. In a flexible mandate, when a fund manager is buying or selling stocks, they are not incurring that taxation. The third issue with this is there are mismatches in expectations between the investor and the fund manager at times. So an investor might be investing in a manufacturing fund or a defense fund with the idea that 5 years later, I will outperform the market. But the fund manager is not working with that aim. The fund manager is working with the aim that I want to outperform that respective index. So 5 years down the line, you might have a scenario wherein the fund has outperformed the respective index, but has underperformed the market. And the investor is unhappy, but the fund manager believes they've done their job. So the expectations might not be aligned. The other issue with constrained funds is that if you look at any time period in history, you will find that at any given point of time, different sectors or styles have stocks that are performing well. So even during dot-com bubble, if you looked at only the top 20 percentile of stocks, 30% of them were tech stocks, but the rest were from all other sectors. Similarly, in 2007, around 25 to 30% were from sectors like realty and infrastructure, but the rest were from all different sectors. When you have a constraint mandate, you are restricting the fund manager to only invest in that specific sector. And even if there are opportunities in all the other sectors, that fund manager cannot access those. So I'll just put this quote out there, and this is from this book called The Bull by Maggie Mahar. And this is post the dot-com bubble. They interviewed a technology fund manager and they were taking the view of what happened. And the fund manager says, in any sector, there are times when you don't want to be buying the sector has been a favorite for a long time and now it's overpriced. There are no good values. But if new money is coming in and everyone expects you to be fully invested, you have to buy. If I had a choice, I wouldn't run a sector fund again unless I could also short the sector or at least go into cash. So once we've picked the fund house, a particular scheme, it is important to also look at how that fits into your own portfolio. And typically what you want is you want a certain diversification of styles or segments in your own portfolio. So if you already have an investment in a fund, which let's say invest in large cap compounding stocks, then you might prefer another fund which invests in cyclicals or special situations or a different kind of style. So you want funds which adopt different kinds of styles. Again, when you're looking at investing with a fund manager, in many cases, you do not have the option between different structures. So typically, a person might be only running a PMS, and if you want to invest with him, then that's the only option you have. But in some cases, you might have the option or you might have to choose between different structures. And typically, between, let's say, a mutual fund, a PMS, and an AIF, a mutual fund tends to be a much better structure. The reason is the minimum investment amount in a mutual fund structure is much lower than what it is for a PMS or an AIF. And consequently, even with a limited corpus or limited capital, you can diversify well. You can keep investing small amounts over a period of time. Some of those flexibilities you might not have with something like a PMS or an AIF. On taxation, in case of a mutual fund, when the fund manager buys or sells stocks, the investor does not have a tax liability. Only when the investor redeems do they incur a tax liability. So you can invest in a fund, stay invested for a long number of years and let that compound without incurring tax liability in between. In case of a PMS, anytime the fund manager will buy or sell, or anytime a fund manager will sell the existing holdings, the investor will incur a tax liability. In terms of flexibility to use different instruments, again, a mutual fund can use derivatives, and again, they can use derivatives without a tax implication. So, irrespective of whether they're using derivatives or not, the taxation remains the same. That might not be the case when it comes to PMS or AIF. It's also an easier investment to manage. Typically, you have a single statement or you have a single holding in your statement. Filing returns is easy. Tracking the performance of the fund is easy versus, at least a PMS wherein you are holding individual stocks in your name. One area wherein a PMS or an AIF might have an advantage is investment flexibility. So if you are someone who needs customizations or if you are someone who needs things like very highly concentrated portfolios or very specific customizations, then that is something that a mutual fund might not be able to offer you, but a PMS might be able to offer you. Finally, even a great fund manager or even a fund manager which can generate a great performance, that performance can be nullified by an excessive fee structure. So a high enough fee structure can nullify a fund manager's performance irrespective of how great it is. So Buffett had this bet with Ted Sides, wherein Ted Sides picked 5 hedge fund of funds and said that these will outperform an index fund, and Buffett took the opposite side. And Buffett won that bet by a big margin. In his subsequent analysis of the bet, one of the things that he was highly critical of was the fee structure that was there for these fund of funds. So these fund of funds charged a 220 fee structure, a 2% fixed and a 20% performance fee in many cases without a clawback. So in up markets, they charged the performance fee, but when the performance subsequently faltered, that fee was not clawed back. Over and above that, the fund of fund manager charged a 1% fee for managing that fund of fund. So he estimated that in together 60% of the performance actually went as fee to these managers. So at that kind of a fee level, it is impractical to expect that such a structure can outperform the market. Now, one reason that is typically given in favor of performance fee is that it brings in a skin in the game or an alignment of interest from the fund manager. So if there is a performance fee, then the fund manager is incentivized to perform better. And Terry Smith, who runs the Fundsmith funds, he did this analysis for Berkshire Hathaway, and he argued that if Buffett had charged a 220 fee kind of a fee structure, then $1,000 invested at inception of Berkshire Hathaway, instead of growing to 4.3 million by 2010, would have only grown to $300,000. So 4 million out of $4.3 million would have actually gone to Buffett as a performance fee. And his essential argument was that performance fee is a really expensive way to bring in alignment of interests. A better way is if the fund manager is invested substantially in the same fund on the exact same terms. That is a better way to bring in alignment of interest. So this is the final slide, just recapping all the things that we've discussed. For returns, focus on long-term returns. Even long-term returns by itself are not sufficient, so we need to do the entire due diligence, understanding the investment philosophy of the fund manager, how long and stable the fund management team is, what is the philosophy of the fund house, the due diligence for the organization. If we have an option, prefer flexible mandates over constrained mandates. How does the fund fit or the fund strategy fit in with our own portfolio? What is the structure of the fund? Ideally prefer MF versus a PMS or an AIF. For skin in the game, it's ideal if the fund manager or the fund management team has substantial amount of their own net worth invested in the fund and a fee structure that is reasonable. So, thank you. Any questions?
Thanks, Rukun, for the presentation. I thought the answer would be PPFS, but
No, my compliance officer is sitting there. I can't answer.
So my question is, in the scatter plot, why did you not consider the relative performance with index rather than absolute performance for 1 and 3 years?
So it won't matter, right? Because in when you're looking at relative performance, you will subtract the benchmark from all those funds. So the result will still remain the same because you're subtracting the same amount from every fund. The idea is a best performing fund has no implication, or you can't select a best performing fund based on 1 year return and expect that it will remain the best performing next year. So even if you subtract the benchmark, which will be the same that you will subtract from all the funds, your results will remain the same.
Thank you.
Yeah, sir, I have a question on the incentive slide that you mentioned. Now, I would want to understand a little bit more, because typically the fee structures are some percentage. It could be 20%. Somebody could charge a little lower. Okay, and if you say that the best way to incentivize is to have them invest in the same fund as you are doing. Okay, so what you are effectively saying is that the money that I want to pay him as incentive is what I should say. Instead of paying him 20%, I'll say that I'll park 10 rupee or 10% of the total fund into the same stocks that you are recommending. Is this the way to incentivize?
No. What I'm saying is that rather than having a performance fee as an alignment, have a fixed fee kind of a structure, a reasonable fixed fee. The alignment comes if the fund manager is himself or herself has a substantial equity or their own fund invested in the fund. Now you can't do it. You can't force a fund manager to do it. But if they have that, if a fund manager has invested their own net worth in the fund, then you will have an automatic alignment of interest. You don't need a performance fee to incentivize the fund manager to do well.
But then how do we, in practical terms, how do I implement this?
No, so yeah, the fund, in most cases, the fund managers will tell you that this is how much I have invested in my own fund. So you can't force this. You can't forcibly tell them. But if whatever amount it is, they will typically tell you that this is how much of my own capital is invested in the fund. And based on that, you can take a decision whether there is an alignment of interest or not.
Hi, Rukun. Great presentation. Two quick questions. One is that I'm hoping that it's on a lot of other people's mind, but I'm really surprised that you completed the entire presentation without the use of the word rolling. So, is rolling returns a factor at all? That because I think typically ends up being the most popular metric that people try to look at in terms of at least looking at returns rather than trailing or point to point. So one, any thoughts on rolling returns? The second is that I think you talked about a lot of points, all of which made sense. Does this approach, in the end, are you saying that this remains a completely qualitative exercise, or does it lend itself to some form of data modeling? I of course don't mean the rating kind where you just give 1 year, 3 year, itna percent, not that, but can this be modeled into some form? Do you think it's possible at all, where different factors are given some kind of weight so that there can be some, because at the end of the day, then how does one remove one's bias from this unless one models it in some form?
Yeah, so on the first point, yes, rolling returns are better. So whatever I spoke of returns, anywhere you can substitute that with rolling returns and that would be a better outcome. The problem is, again, 1 year rolling returns are not a great idea. 3 year rolling returns are not a great idea. I wanted to use 5 year rolling returns, but you simply don't have enough fund manager. If you are looking at an average 5 year rolling return, you need a fund manager who's there with the fund for like 10, 15 years. And as I said, that's hardly like 6% of the entire universe. So it's perfectly right. Prefer rolling returns over point-to-point returns. Because of the limitations of the data that is there, I presented with returns. On the second point, I think it's a mix of both. You can't purely construct a quantitative model. One, because there is severe issues or there is a severe shortage of data here. So if you actually filter out the available data, it's like for most cases, you have 10 years of history, and in a large majority of funds, you will find that the fund management team has consistently changed in and out. So that is what makes it very difficult to make it a purely quantitative exercise. You can use risk metrics and returns as an initial filter, probably exclude something like 20-30% of the funds based on these metrics. But beyond that, I think it will come to making qualitative adjustments or making qualitative judgments about the fund or the fund manager.
Just a quick follow-up on the first question, which is that you mentioned that rolling. I understand that if you try to look for fund managers who stayed for that long, obviously there's literally nobody. But are you therefore suggesting that it is not wise to look at rolling returns while disregarding whether the fund manager has changed or has remained the same, which means effectively there are funds which have been there for 10 years, 15 years, and therefore just looking at rolling returns without bothering whether the fund manager has changed or not. Are you suggesting that's not a wise thing to do?
Yeah, so in my view, the performance of the fund is a combination of the environment that the fund house provides. That's a huge part, but also the discretion of that fund manager. So if the fund management team or if there is a substantial turnover that has happened, then yes, you cannot rely on those rolling returns to make a judgment about what will happen in the future.
Thank you.
So,
yeah.
Yeah, great presentation, Rukun. So I have a comment, and I don't know if you have come across that a particular thing in your study. So in the beginning, you talked about the reason why somebody is recommending active versus passive, right? So the question is, when you are all those index funds are ranked based on market cap, but that market cap itself, isn't it defined by the active managers? There are some people who are studying various companies, they are trying to assign valuation. So they are talking about two types of investor. One is invested in index fund and the rest of them totally own the same market. But who is determining the market cap of each unit? Which share should fall in which index, or it should move out or not? It's determined by some active managers, right?
Yeah.
So if everybody owned only index funds, who would determine the market cap and therefore the index composition? So by definition, you need some intelligent active managers to determine the right valuation of the market. Okay. So that was one point. And, in that context, I would point out that in recent history, there were some stocks in India which were rigged and deliberately put into some indices. And therefore they drew a lot of flows into them, and that actually benefited those companies, right? So it's even, if you rely completely on index investment, you might end up, and if the index investing becomes a very large part of the market, it may actually not be a good idea to invest in those funds. That's what I'm pointing out.
No,
So I
you're
don't know if
right. So I think that's the argument that more or less everybody accepts, that you need some form of active management, or at least some proportion of active management. The debate is, and I don't have an answer to that debate, is what should be that percent, or where do you draw the line wherein passives become so big that the flows themselves start impacting or the fundamentals are no longer as relevant. So in markets like US, there is a lot of debate around this because their passives have become a very large portion. I don't think there's an answer yet on that subject as to where do you draw that line. But yes, in my view, there has to be some form of active management to arrive at a rational price for any stock, or at least a reasonable price for a stock.
Thank you.
Hi.
Yeah.
So very good presentation. I want to specifically talk about skin in the game.
Yeah.
So while all other data are available, do we have a data on that particular aspect of what is the kind of money that is put in by the team of fund or fund managers? Because I think in early 2000 or no, mid 2000, one of my friends joined Monsoon Fund. And the first condition of Monsoon Fund was that you will have to put money yourself in some proportion to the portfolio that you build. And that condition was there for even junior analyst in proportion of his salary or bonuses and all that. It was a very good idea. And I know some of the fund in India are also doing it. But is it quantifiable? Is it available, those data?
Not to my knowledge. So there is no, typically you have databases that do mutual funds, but it is not a mandatory requirement to disclose that number. So some fund houses disclose that, some do not disclose that, and consequently you do not have a single database which you can screen out and see that, this is how much, this is what is the skin in the game for individual funds.
Just one point here. So SEBI has a regulation where SEBI has told that 20% of fund managers and HODs pay compulsorily has to be invested in the schemes that they manage. So this is a regulation which came back 2-3 years back. So that is already there.
Yeah, so there is a requirement. I'll just take the Zoom question, which is what are certain ways / metrics where we may be able to track that a mutual fund manager is doing what he said he would do? Yeah, so essentially what you're trying to do is look at the strategy and look at the portfolio of that fund manager over a period of time. Typically, I think if you understand the strategy well, then you will be able to understand or correlate to 60-70% of the fund. Not all holdings you might not be able to appreciate all the holdings that are there, but to a large extent, you can look at a portfolio and make a educated assessment that this portfolio is based on this strategy. And again, not at a point in time, but look at it over a period of 4 or 5 years. And I think that should help. And again, other things like exposure to sectors, portfolio, that can tell you whether the fund manager is focusing on a certain sector or not, or is he largely diversified across sectors. Things like portfolio turnover will tell you whether it's a buy and hold fund or it's a fund wherein there is a constant churn. Again, does that correlate with what the fund manager is saying? So some of these metrics can help us answer that question.
Yeah.
Where can we find data such as active share and information ratio, as most funds don't provide the same? So information ratio is something I think SEBI is now contemplating or has already mandated. So some of these ratios are there in the fact sheet. Things like active share, there are sites like Prime Investor and all. I'm not exactly sure whether they provide or not, but okay, so they don't provide it. But you can take all funds disclose their monthly portfolio holdings. So you can download those holdings and you can download the benchmark and see how much of overlap is there. Again, not an exercise that is very easy to do, or I'm not aware of a database that tells you this very quickly. It will take some time and effort, but using monthly portfolio holdings is what you'll have to do that.
Hi,
Yeah.
sir. Am I audible? Yeah, I just wanted to understand on the fund side, said that 2/20 as the fee structure, right? Is that true that the difference is so high between the Berkshire Hathaway example that Warren Buffett can make it so high? Because there is a concept called as high water mark, right?
Yeah, so the thing is, in a structure like that, the compounding does not take place. So if you have a 220 structure wherein even if there is a high water mark, and let's say a fund delivered 30%, then you are taking away, let's say, and as a threshold of, let's say, 10%. So then out of the incremental 20%, you are taking 4% away. So what is happening is, over a period of time, your capital is not compounding completely. Every year, some or the other portion gets taken away as performance fee. And this thing over a period of time compounds by a big margin. So I know it sounds like a really wide difference, but if you do that on an Excel and over a long period of time, that, this is like almost a 40-year period. So over a 40-year period, compounding can lead to very divergent results.
That would be true if there is clawback as taken into consideration, but it will not be true as if it is high water mark. Because let's talk about an example, like rupees, if I consider as 2%, it's 2 rupees will be charged as a fund fee.
Yeah.
If the performance is like 30%, that means that 30 rupees has been delivered and 2 rupees is already been taken. So there is 28 rupees left out with him, and the 20% of 28 rupees is what been paid, right?
Yeah.
So if I compound, if tomorrow if my fund doesn't go above 130 rupees, it comes down to 120, then there is the payback, right?
There is no fees on that year, you're right. But you are still down that performance fee versus no performance fee, right? The incremental return, whenever it comes, that portion of capital has been taken away, right? So over a period of time, that will compound. It's the same with taxation, right? You might argue that when I'm buying or selling, I'm paying a 15% taxation. Why does it matter so much? But compounded long enough for a period of time, that can add to a very large amount. So Buffett did that exercise for hedge fund of funds, and he said that 60% of the performance went as fees. So if you do the math, you will realize that over a long period of time, that compounding makes the number very wide.
Thanks.
Okay, thanks a lot. Thank you, everyone.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.